Hello everyone, I'm Christian with Reina Property Group, and at Reina Property Group we provide financial modeling, investment presentation services, as well as investment advisory services. And in this walkthrough, I'll be showcasing 3 waterfall distribution schedules that we use and implement for real estate syndications. So the first is going to be the IRR-based Pari Passu schedule, where we are making distributions in the preferred return Pari Passu, so in proportion to the GP and LP's respective equity contributions. The second is going to be another IRR-based waterfall, which features a GP catch-up provision. And then finally, we have a much more institutional and granular IRR and equity multiple-based schedule, which we're tracking both of those metrics in that. And so we advise clients on a range of promote structures that are tailored to their specific investment strategy, as well as the capital partner profile. And each of these frameworks reflects a different approach to structuring distributions, aligning incentives, and of course, optimizing sponsor promote economics. And so this video is designed to illustrate the distinctions between these waterfall distribution structures, how we model them, and the strategic considerations sponsors should evaluate when selecting the right framework for their deal. And I'll have a brief slide at the end of this video explaining exactly how we determine which structure will be best for your next investment opportunity. The first waterfall structure, as mentioned, is an IRR-based waterfall with a Pari Passu preferred return hurdle. And so this is pretty straightforward. This is perhaps the simplest of the 3 waterfalls that we'll be covering today. And so here we have our partnership returns here. So we're looking at returns for the deal, the levered returns, of course, and then we have our partnership splits here, which of course which is the result of the distributions that we're making in this waterfall. So we have our summary here, and then of course we have checks built in here to make sure that every dollar is accounted for in the deal. Here is where we change our inputs. So we have our preferred return, and so here it's set to 10%. But if we want to change this to 8%, that's a simple change, and the model will update accordingly. And so we have that. And we see, again, this is a Pari Passu waterfall. So the GP cash flow and the LP cash flow in the preferred return are direct linkages to their equity contribution, which we have here. And then we have our IRR check. So depending on what we input here, the IRR check should match that, assuming that the deal does achieve that preferred return. And then we have tier 2, tier 3, and tier 4. So tier 4 is our catch-all, and then tiers 2 and 3 are based on whatever you decide to input as the given hurdle rate for that hurdle. And so we have our promote here. So we have a 20% promote in tier 2, which means that the LP is essentially tipping or gifting the GP 20% of their allocated cash flows for their sound performance in the deal. And then finally, we have the distribution frequency here. So some sponsors prefer to make distributions on a quarterly basis, and then we built in annually as well. And so you can toggle between monthly or you can choose quarterly, and the model will update accordingly. And then here, these are all of the different tranches of the waterfall, the different tiers that we're showing here, and then our summation for the LPs and the GPs here. And then finally, we have our annual distribution summary over here, so we can see exactly how the distributions are being made on an annual basis. The next waterfall structure that we'll be looking at is another IRR-based waterfall, this time featuring a GP catch-up provision. So here we have our summary statistics for the deal, we have the levered returns, and then we have the return metrics following the waterfall schedule. So these are the GP returns, and then these are the LP returns. And again, these returns are directly informed by the assumptions that we input here, which is where we can change the assumptions for the different hurdles in this waterfall structure. So the first hurdle that we're working with is the preferred return hurdle. And so here we have our return set to 8%, meaning that up to an 8% IRR, the GP will receive 0% of the cash flows, and the LP will receive 100% of the cash flows. And then we have checks built into the model as well. So we have an LP IRR check. And so this is making sure that based on the assumption that we have here, the LP is actually hitting that IRR based on the distributions that we have. And of course, this is based under the assumption that the deal is actually profitable enough for the LP to achieve an 8% IRR. And then finally, we have an LP percentage split check, and this is making sure that the LP cash flow here, which is set to be 100%, based on the 0% GP cash flow, that's actually the case. And so we see that is the case, so we know that that hurdle is working correctly. Next, we move on to the GP catch-up provision. This is where this type of waterfall structure gets its name from, because the GP will catch up to the LP cash flows by receiving, in this case, 100% of the cash flows up to and including when the total profits distributed is equal to 20%. So the GP will have 20% of the profits at this point in time. And again, they will be receiving 100% of the cash flows. And so here, the LP percentage split check is 0% because, again, the GP is receiving 100% of the cash flows. And then the LP IRR check, we don't have that here because there are no distributions made to the LP in this case. Next, we have tier 3. So up to and including a 15% IRR, the GP will receive 30% of the cash flows, and the LP will receive the remaining 70%. And so the LP IRR check we see here is 15%. And again, that should be the case because we inputted 15% here. And so the LP split check is 70%. And so we know that the model is functioning correctly. And then finally, we have our tier 4 hurdle, which is a catch-all. The GP and the LP will split the cash flows 50-50. And then finally, we can change the distribution frequency here, just as we did in the Pari waterfall. And so we can change this to quarterly from monthly, and that will update accordingly. And then we can also make annual distributions as well. And so the model will update seamlessly. And so we see how that is flowing here based on our annual distribution schedule, which is our summary. So it's taking the sum of all of the cash flows for the given year and just aggregating them on a yearly basis here. The final waterfall structure that we'll be going over today is the IRR and equity multiple hybrid schedule. So looking at the different hurdles, we have an IRR-based preferred return, and here we're saying that the preferred rate of return here is 8%, and the cash flows are being distributed pari passu. And so we have an LP IRR check, and we see that's equal to 8%. And then we have an LP equity multiple check, but that doesn't apply here since that isn't a constraint in the preferred return hurdle. Moving on to tier 2, what we're saying here is that for all of the cash flows above an 8% IRR and up to and including a 12% IRR, the GP will receive a 20% promote, which means that the GP will be receiving 28% of the available cash flows between this 8% IRR and up to and including the 12% IRR. The LP will receive the remaining 72%. And again, we have the checks here. We have the LP IRR check, so we see that's accurately 12%, and then we have an equity multiple check as well, but again, that doesn't apply in this tier because there is no equity multiple constraint. Moving on to tier 3, this is where the hybrid schedule comes into play. So the IRR here is 15% and the equity multiple is 2x. And what this is saying is in order for the GP to enjoy the cash flows, so this 50% promote in tier 4, both a 15% IRR and an equity multiple of 2x must be achieved before the GP receives any payout in tier 4. And so the promote here is 30%, so the GP will see that regardless of whether a 15% IRR or a 2x equity multiple is achieved. But again, in order to get to tier 4, both of these must be true, and we see that to be the case for the LP IRR check and the LP equity multiple check. The LP IRR check is showing a 19.52% IRR based on the 15% IRR, so that's good. And then the LP equity multiple check is showing a 2x equity multiple, and so clearly both of these requirements are met, and so the GP will be receiving cash flows in tier 4. And so if we scroll down to tier 4, we see that there are distributions here as shown here. And again, we have the capability to change the distribution frequency. So we can change to quarterly, for example. And we have that, and then we can also show it on an annual basis as well. So finally, here's just a summary of the different waterfall structures. So for the Pari Passu IRR-based waterfall structure, The big advantage here is that this structure is simple to implement and explain, so I think it's ideal for smaller deals or closely held joint ventures, and it works best when the GP is contributing significant equity and wants to share the preferred returns pro rata with the LPs, which is what we discussed. But there is a drawback here, and the drawback is that it offers fair alignment of interest, but it may be less attractive to institutional LPs like pension funds or funds that maybe just want to protect their risk a little bit more. They are definitely going to prefer the second waterfall that we went over, which is the GP Catch-Up. And this structure introduces moderate complexity, but it's widely accepted in institutional settings, and it still clearly aligns the incentives. So it's best in value add or opportunistic deals where strong performance should reward the GP with a disproportionate share of upside after meeting investor return targets. And so the catch-up mechanism ensures that the GP is fully motivated to exceed hurdle rates, but the reason why those more institutional limited partners prefer this is because they will be receiving 100% of the cash flows in the preferred return hurdle before the GP sees any sort of outsized return or before the GP even receives a return of capital. And then finally, the IRR and equity multiple hybrid schedule. This is the most complex schedule of the three, but it provides the strongest downside protection for the LPs by requiring both the time-based metric, which is the IRR, and then absolute return hurdles, which is captured by the equity multiple constraint. And so it's best for longer hold development or capital intensive deals where a high IRR alone may not reflect true profitability. Won't get into the technicals there, but of course the IRR can be heavily swayed due to the time value of money. And so the equity multiple really makes sure that any deals aren't artificially deemed more attractive because of the IRR. So that's why we include the equity multiple in the hybrid schedule. And so you'll want to use this when LPs want to prevent early promote payouts unless substantial total returns are achieved. And then here we just have a breakdown of each of the waterfall structures based on the LP priority, the GP co-invest incentive, and then finally the complexity. So the LP priority is going to be medium for pari passu. They're just being paid back in proportion to what they contributed into the deal. So it's not like there's no extreme preference for the LP or extreme preference for the GP. This is sort of fair before the promote structure kicks in. Of course, the LP priority in the GP catch-up case and the hybrid case are both high. GP co-invest incentive is high in all of these cases. That's the very purpose for having a waterfall structure. And then complexity is going to be lowest for the pari passu case. If you've learned this in school or if you've done a deal before, this is likely the one you would have seen, considering it may have been a smaller deal. Once dealing with institutional players, this is what you're going to see more often than not, is the IRR-based waterfall with a GP catch-up. But if you are working on a particularly complex deal, based on this description that we have here, well then you may run into the IRR and equity multiple hybrid schedule, and that has the highest complexity. But regardless, we use these three schedules to align the incentives of all of the capital providers in the deal. And these are the sort of schedules that we'll use to really make the deal attractive to potential stakeholders. So if you would like to begin a formal engagement with us, or if you just have any questions, feel free to visit us at reinapropertygroup.com or email me directly at christian.reina@reinapg.com, and I'll leave my email and contact information